Association of Financial Advisors of India. Knowledge Series in association with Resurgent India ICICI Bank presents a virtual seminar on managing credit and foreign exchange risks for exporters. Moderator Mr. K. Gupta, Director, Resurgent India Limited. Mr. K. Gupta is the Director at Resurgent India Limited, specializing in corporate finance and management consultancy for SMEs as well as large corporations, handling substantial financial transactions. He also serves as a task force member for government MoUs and on the grievance committee at Power Finance Corporation. With a 36-year banking background and a tenure as General Manager at Central Bank of India, he holds degrees in economics and bank management. Key speakers: Mr. Gaurang Vaswada, Trainer, ex-banker and partner, FEX Fien Associates LLP. Mr. Gaurang Vaswada is an ex-banker with 35 years of experience in international trade, finance, and foreign exchange. He has held various positions during his banking career, including that of Chief Dealer Forex and Head of International Division at erstwhile Bank of Rajasthan and as Branch Head, Compliance Manager and Subject Matter Expert, SME, Trade with ICICI Bank. At present, he is actively involved in training for trade and forex-related subjects in and out of the banks and advising corporates in matters involving FEMA and RBI guidelines. He is also a resource person for the Indian Institute of Banking and Finance, IIBF, and faculty for FEDAI. Mr. Bhavin Joshi, SME, Trade Finance, ICICI Bank. Working with ICICI Bank in Trade Finance Department and having 15 years of experience and currently holding position as Subject Matter Expert, SME, Trade Finance total experience of 20 years and have done CMA and KEB, working with ICICI for last 3 years.
Good evening, friends. I am your host K. Gupta here. I am a director of Association for Financial Advisor of India and also Resurgent India. This is our 9th program under the series of the ICICI Bank, where our respected Gaurang Vaswada is under this webinar. And we are getting a very good feedback in remaining 8 webinars, and more than 1,000 participants are also there who have given excellent feedback, so which give us encouragement to hold such webinars. On the request of our participants, of the bankers and our entrepreneurs, they require that what are the risk factors, how it can be mitigated, the risk under the foreign exchange. That's why the subject has been chosen, where the managing the credit and foreign exchange risk for exporters. I think this is a subject matter where Mr. Gaurang will going to discuss the various aspects of the risk in international trade. This is the most important issue here. Then export credit for exporter and how to control that. Credit insurance, how the credit insurance is working, which is the main tool to mitigate the credit risk. Then ECGC, the government organization to support export credit risk. Foreign exchange risk for export, when and how it is coming. That impact of foreign exchange volatility in foreign rate. Hedging strategy for managing the currency risk. These are the basic points which we are going to discuss. Risk factor is there, whether you are talking about the exchange risk, exchange, there are so many options with us. forward contract looking to exchange rates for future transactions, currency option is available, money market hedging is also available. That means natural hedging is also there. Then diversifications, then use of netting and loading and logging. These are the factors which we can cover at the ECGC and other insurance companies, even factoring, also come out by the ECGC, which is also helping us. The major aspect is a transaction risk, which translations and economic risk, which can be calculated. While the foreign exchange risk can be calculated by value at risk calculation method. I'm not taking much time, so I welcome all the participants and our respected speakers, Mr. Gaurang Baswada and ICICI representative from SME Trade Finance, ICICI Bank, Mr. Bhavan Joshi. So I request Shri Gaurang Baswada ji for the point which we have listed in our agenda of discussions. Please discuss with our participants. And I request all the participants, if you're in mind any type of risk which I have already told you, beside that, any risk factor you want to mitigate that risk factor, please use your write up, send to us. So we will try to reply your all this how to mitigate your risk factor. Please participate so that this webinar can be put to be useful for all the participants. Now I request Shri Gaurang sir, please take up the session. Gaurang sir, please.
Thank you, K.K. Gupta sir, for the introduction and the risk in right perspective. You cannot avoid risk because business is ultimately risk only. So, very rightly said that the credit risk and the foreign exchange risk, which we fear, which we have to take care of it. And we will see during this session today how we can control risk or how we can put the risk in certain control level so that our business goes on smoothly. I'll just share my presentation and from there we go. So, screen is visible, sir?
Visible, please go ahead.
So managing the credit forex risk, credit and forex risk is the title for the day. So we will look at both the aspects of credit and forex risk. So before I start, let me wish you a very happy New Year. First webinar with the financial analyst and the researcher in India for me in this new year. And very rightly said by Gupta sir that this is the 9th in this series which we had. And I hope that the deliberations in the seminar will be useful to all the participants. Now, what we are going to discuss is what are the risks in international trade and thereby the credit risk, what and why, and managing the credit risk. The second part would be on the foreign exchange risk, what and why, managing foreign exchange risk. And question answers, you can put in your in the chat box or we will take it at the end. So when we talk of risks, where does the risk start? When we talk of exports, the first part or the first major work for an exporter is to identify a proper buyer. Now, this proper buyer is something which is again within the inverted commas, how proper needs to be done, what due diligence needs to be done, and how to avoid the risk. Do not fall into traps, do not fall into frauds. All those things need to be taken care when we are identifying a buyer. Don't jump upon the first mail which you receive for maybe 10,000 pieces of XYZ commodity or 1,000 tons of rice or anything like that. But identify the buyer, have a proper due diligence, spend time, try to find out the antecedents of the buyer, from whom other people the buyer is buying in India, whether he's an established player, whether he has got a good address there, maybe somebody is in Dubai, you can ask any known person in Dubai to find out, try to find out from associations, chambers, maybe even our embassies could help you in finding out a good buyer. So the word good buyer means that I must be sure that the buyer is not going to ditch me and it is not a fraudulent trap. The next is the order. Now, when I'm making an order, it should have all the ingredients of an order, not only the price or the rate or the shipment schedule, the total value, quantity, quality, etc. But beyond that, there could be several questions where I would say, what if? Now, this what if needs to be covered in the order. What if there is a ban? What if there is a war? What if there is a COVID? What if I'm not able to ship? What if the buyer does not do XYZ items? Those all questions should be responded or put in word, in maybe in letters in an order. Now, once an order is there, I am more than happy because order is something which will maybe start my business. So the next challenge is shipment. Now, the shipment has to be as per the order terms. The shipment has to be the preparation of the good, the packing of the good, the shipment of the good. Everything should be as per the terms of the contract and as prevalent in the system or as prevalent for that particular commodity. Now, going forward, my payment is also. So, does this cycle complete the turnaround of a trade or not? I feel that there is a risk between these two items, buyer and order. There is a risk between order and shipment. There is a risk between shipment and payment. And also, it does not stop here. There is also a risk between payment and buyer again. Once, even if the payment is made, if the buyer is fraudulent, you will not receive the payment. You only receive a copy of the SWIFT message stating that payment has been made, and that SWIFT message or that message is also a fraudulent message. So the risk is not over yet. That is why my first emphasis on the buyer end. Business is risk you cannot eliminate. I cannot eliminate when I am doing a business, and particularly cross-border trade when we are miles away. It is not between Mumbai and Pune or Mumbai and Chennai or Delhi and Kanpur or Kanpur and Chennai. No, it is miles away. So my risk increases because I am not one-to-one with my buyer. I am not in that place. I do not know many of the things of that country. So in an international business, I would perceive there are risks, all risks, which should include credit risk, the shipping related risk, the country related risk, the IPR related risk, the documentation risk. Because of the two countries involved, documentation risk, the forex risk. Now, country risk, documentation risk, credit risk, and forex risk would somewhere or the other be covered under this session. But let us also see that if there are any shipment risks, how do I cover that? If there are IPR risks, can I do a registration or should I apply for a registration for an IPR risk? Whether I should engage with somebody to know that what documents are required and what could be legal repercussion of not filing good documents in the other country also. So let that be covered there. Now, the major risk what we find now is the global economic scenario. Even if an order is there, even if a good buyer is there, even if the shipment is made in good terms, but I do not get payment because of the turnaround or the downturn of an economic. The goods are dumped in another port, the buyer does not come forward, the goods have been taken by the buyer, but there is no market for him, no scenario. And the geopolitical issues, one up. The geopolitical issues is something where overnight there could be certain maybe declarations by the governments of dealing with certain countries, not dealing with certain countries, and all those things. This also we need to see. Now, when I talk of, I'll spend some 5-10 minutes on the global economy, and then we move to specifics of credit risk and the foreign. Global risk of more downside rather than improving. I do not see in very near future that the things are going to improve. And the last data of December also, we have seen that exports have not grown from India. There's a high trade policy uncertainty between the countries now. The new government in USA is going to come up on the 20th, and maybe all uncertainties around that. Whatever has been uttered, maybe they've uttered till now in the last 1 month. We have seen that economies have just keeping themselves covered with what uncertainty is there with that new government coming up in the US. The geopolitical tensions leading to trade fragmentation and more disruptions of the trade. So maybe till yesterday, now only yesterday it has been announced that the war is going to towards an end. There's going to ceasefire so that the Red Sea crisis is going to be over in some days. But still that will hover or maybe somewhere around us only. Delayed monetary easing due to high inflation. Now, this is very pertinent for us in our country that even though the interest rates have been lowered in US or some other countries, we are unable to do it because of high inflation and major election across the country because all in throughout the world there have been some maybe around 70 countries. 64 is this number, but somewhere else it is 70 plus countries where the governments have changed in the entire world in 2024. So all that with also the change in policies could impact that. So the actual wars versus cold wars, the high inflation indicators, the interest rate easing or tightening could impact us. Slow investment climate because of the interest rate scenario or the uncertainty in the business environment. Slowdown in economies because of that, the relaxations are maybe slower than expected. The governments, central governments want to ease or want not do not want to ease because of the inflationary pressures because they are both they have to balance out in both growth and inflation. And the job market in USA and major economies does not seem to be improving very drastically. We have we have this geopolitical issue of Russia, Ukraine not stopping, Hamas maybe slightly lowered down, but let us see what happens with the Red Sea in the coming days. So there are more than 45 armed conflicts are currently taking place throughout the Middle East and North Africa in the following territories. Maybe Cyprus, Egypt, Israel, Iraq, Libya, Morocco, Palestine, Syria, Turkey, Yemen, and Western Sahara. The risks associated with wars, terrorist acts, and tensions between states that affect the normal and peaceful course of. So it is not a normal environment which we are facing currently. For the developing countries, their aim to protect their own industry, trade, and employment is one important thing which has led to China plus one. So they don't want to put all eggs in one basket. So China plus one has been there now. And as the report says that we have not been the major beneficiaries of this China plus one. We are still lagging behind certain other countries. For the emerging countries, the major challenge is internal employment and the restrictions on visa by certain governments. So you every day you see a new news in the visa, maybe US visa or the European visa or the Canadian visa or the UK visa, etc. And the immigration, which is investment linked, it is more difficult for the emerging economies population to take up because of the high stakes there. How does it impact India? Slow growth in developed economies. Because of that, there is a lower demand of goods. Only necessities are being required there. We are beside necessities. We are there in several other items, which like carpets, jewelry, etc. All facing downturn, or maybe the handicraft market particularly. Then high inflation. Demand is for low cost services and outsourcing, so that impacts while we are there to compete in our services market, but ultimately it impacts the realizations also. Geopolitical events, high uncertainty, what will happen and when it will be over, some of those questions like that. The elections all across those 60, 70 countries have changed the politics and policies in those countries. So now everybody wants to show that what new is there. And because of that, they are dumping the old relationship. That is also one of the challenges. So then there is a bias towards specific countries. We may be beneficial. It may be beneficial for us, or it may not be beneficial for us. And for us, we are trying to balance out between all those economies. High interest rate, increasing exports, growth is thus a challenge. Now, this is a challenge because of the various reasons. It is a difficult. So, what is required now? We need to tighten our belts and see that we are not adding any more risk to our existing business. So this is something one chart shows USA, India, UK, Russia, Pakistan, Taiwan, Croatia, Belgium, European Union, South Korea, Ukraine, Australia, Finland, Bhutan, Mauritius, all these countries went to elections in 24. So how do we tighten our belt? Or how do we now go for good business in exports? So we, as a country, we are now trying to close all the maybe what you call loops in the new foreign free trade agreements or economic partnership agreements with certain countries, and maybe we see that in 25 some more may be completed. Find newer countries. If I was dependent on one country, I have to find out newer countries, newer buyers with demand of goods and services, collaborate and help each other grow. So now the government has pushed the export targets from only the center to the state and state to district by creating state level export promotion councils and district level export promotion councils. And there have been targets which are being monitored at district level. Collaborate and help each other grow. So Indian embassies are now required to participate in this. What you can call it is a call for growing exports from India, and they are also required to now represent India for growth of trade in their own country. Supply, now this is more important. Supply what is in demand rather than what you can supply. So normally what happens? I am manufacturing a pen. I would like to supply this pen. No. But if I have to find out what is in demand, and then I can produce or I can maybe see that how I can manage to support that demand which is there in the market. De-dollarization is another aspect where we want more and more trade to be done in rupee, because our imports we cannot stop, and that is why the gap between export and import, maybe the reliance on the dollar, can then be reduced. The major mantra, what I feel, is keep costs in control. All the three: interest cost, credit risk, and the exchange risk, that should be kept in control, so that when things are rough, I can definitely go and explore newer markets by keeping my cost in control. Now, going to managing credit risk. What credit risk is this? Credit is my exposure on the buyer. Now, whether exposure in the buyer means that I have supplied the goods and he has not paid me, no, it is not that. It is beyond that also. Goods sold on site, the goods have been sold on site, the buyer has not taken up and come forward and taken the goods from the port. My goods are lying in some other country, maybe Malaysia or Dubai, etc. And the buyer has not come forward and taken the goods. I am still at risk. I had taken a call on the buyer has backed out. My risk is there from the credit side, the buyer side also. When the goods are sold on credit, there is a clear credit risk. When I give a usance period 90 days, I want to give a credit to the buyer. There is a clear credit risk. I must see that whether the buyer is worthy to trust that he will make payment in 90 days. Sold at site or usance, documents have been sent through bank. Now, even though I have not shipped the goods directly, I have sent the documents through the banking system. Maybe our bank here in India is sending the documents to, say, Emirates Bank in Dubai, or maybe the American Express Bank or any other bank there in USA. The buyer has not come forward to retire the documents or accept the bill of exchange. The goods are lying there. Maybe in 6 days' time, the damage starts. In 30 days' time, they are going to auction it. What happens there? And we get those cases now. Couple of cases I am handling where the goods have been auctioned, and now there is a reverse liability on the exporter because the buyer has vanished. So how do I see that whether this could happen to me or not? So that risk also I have to build in, or I have to take care of that. Now, when I ship the goods directly to the buyer, whether at site or usance, site does not mean anything. It is all usance then. It is on the whims of the buyer how and when he will pay, or whether he will pay or not. I am fully exposed. All risk is at my end. Risk of non-fulfilling the contract terms. The buyer has backed out. He has not taken up the goods from the port. He has not retired the documents. He has not accepted the bill of exchange. His non-fulfillment of the contract term. And once the goods have been taken up, non-payment by them. So this is the challenge. It is not only the usance bill, but beyond that also. Now, how do I cover this? How to control? First and foremost, my first slide, buyer identification. Due diligence on the buyer and research on the buyer's credentials is must. I may engage with certain people. I may engage with credit rating agencies. I may have to go in for a maybe risk report on the buyer. Spend 5,000 rupees, 10,000 rupees on a buyer. It is worth it. Your risk is controlled at, your cost is controlled at 7,500 which DNB takes, or maybe 5,000 rupees which ECGC takes. Your risk is controlled there. If you find that the credentials are not good, the risk rating is bad, you may stop that business or talking to that buyer subsequently. That investment is still better. Now, I can also control by not agreeing to usance terms in the initial trade, just by going on a DP term. Either you pay me advance or I send you the documents through banking system. I still have the control of the goods. I'm not releasing the goods without payment. And once the business is there, maybe 5, 7 transactions, 10 transactions, or 3 years or 2 years of business is there. Maybe I have gone in the buyer's country twice, thrice, and seen that he is well established, he is well known in the market, he is registered with various associations, etc. Then I can switch from advance to DP, DP to usance. Or it could be a payment terms of LC also, provided the buyer agrees and your cost is there because. Now, shipment to order or direct shipment. To order shipment means that the control of the goods is with me. The title to goods is with me. I pass it off to my banker here in India. My banker endorses in favor of the banker abroad. So at least the financial institution is involved. But I must also warn you that the buyer's bank may not be your banker. Try to see that it is a first class bank and you can always take a stake on that bank also. When you ship the goods directly to the buyer, then nothing is in your hand. You make the bill of lading as a consignee to the buyer's name, ABC Dubai. The buyer will go to port and take the goods. Then you have to run after him. Documents through bank or direct to buyer. Now, this is another challenge. If you have sent the documents to the banking system, the bank is an agent of your bank here in India, so they have to abide by what the conditions have been. So the control of the documents, the release of the original set of bill of lading remains with the banking system. If you send the documents to the buyer, then no type of document will save us. I can always have the condition of letter of credit. We find several of the exporters who say, sir, we don't do business without LC or advance payment. No open account business. We find certain exporters which say that for first couple of years, we do only advance payment and LC. After that, we will decide how to do open account, whether to do or not to do. So you have to control that risk by insisting upon. If there is an order, or if there is a requirement of your commodity in a particular country, and even if there are several exporters from India who are supplying that particular product, you have to negotiate with the buyer with maybe the price differential, the quality differential, the shipment differential, or any other credentials to negotiate from open account to LC or advance. Now, one more added risk control factor is that whether I can put a exposure limit on the buyer or the country. For country, we will see how country risk rating is spread out by ECGC. But let me talk about buyer. An exporter who wants to first time export to a third world country or a riskier country may decide that I will not ship more than $10,000 worth of goods on side basis, documents through the banking system, and next shipment will go only when first bill is paid. So there is a limit of $10,000 per buyer in that case. Now this, even for a new buyer in Dubai or Singapore or maybe any other country, the limit is fixed for the first few transactions or first few years for sending the documents through bank, but even the shipment size is not more than say 10,000 or 25,000. Gradually, when you come to know each other, maybe after 1 year of dealing, etc., I can increase this limit to $50,000 or $1 lakh. If it is a usance bill, then also I have to see that I will not take an exposure or not give credit more than $50,000 in maybe third year or second year or like that. But if I do a business of $4 lakh in the first year itself, where I give a credit, issue the shipment or the issue the BL directly consigned to the buyer and send the document to the buyer, then there is no safeguard here for us. So your internal limit system and gut feeling will decide that how to decide on that limit. Now, when you go and take a report from Dun & Bradstreet or Mira Inform or ECGC, they will themselves tell you that what is the buyer good for. When I go to ECGC, ECGC will give us all those risk parameters. So then I move to credit insurance. Now, I per se by sitting in India, on a buyer in Dubai or on a buyer in Malaysia or on a buyer in Madagascar or on a buyer in maybe any other Latin American country, I cannot decide that what limit I should put. So I go to a credit insurance company. Even if I buy or if I subscribe to a what you call the credit rating, credit risk parameters from DNB or Mira Inform or any other company, but still I need insurance for my business because that is what is going to save me. Now, what is this? This is something where you are spending maybe on an insurance a premium ranging from 0.5% to maybe 1.5% or so. Not beyond there. Very unlikely it would be in only very riskier countries that their premium goes beyond 1%. So credit insurance, we have ECGC, Export Credit Guarantee Corporation, which also KK Gupta sir mentioned about that we can go for credit insurance. Now, credit insurance is given by the government organization, which is called Export Credit Guarantee Corporation. Now, besides ECGC, certain private non-life insurance like maybe Bajaj or what do you call New India, they are there in this business, but I'm not sure how strongly they are there in this credit insurance. What actually it gives? It gives a credit guarantee to exporters for supporting export growth. When you are exposed to your buyer, it stands behind you, gives you a risk parameter or risk control tools to say that I am with you, and these policies are all loss sharing policy. So maybe ranging from 75% to 90% of the risk is covered here. Credit guarantee is given by the ECGC. Also, it is available on goods and services both. Now, there are certain policies which are given or insurance policies which are given to banks and financial institutions also because they finance our portfolio. So when I take an packing credit or a post-shipment finance, and if a bank has taken a whole turnover policy, then bank will also cover it. There could be separate two covers, one for exporter, one for bank. Now, bank's risk insurance relates to pre-shipment and post-shipment finance, whereas the exporters only get the insurance on the post-shipment when the goods have been shipped and the risk is on the buyer. Till the goods are in their hand, there is no cover given to the exporter. There are also deferred credit insurance policies for project exports, whole turnover cover for banks, both on pre and post shipment, which we call export credit insurance for banks, and these are all policies under IRDA guidelines. The exporter policy could be turnover policy, buyer specific policy, country specific policy, and very specific shipment cover for the exporter. The standard policies could be turnover based, can cover commercial and political risk, covers up to 90%, and maybe the small or tiny exporters, there is a limit of 95% also. It goes up to 95% of the risk of the invoice value. These policies would exclude disputes with the buyer. The import license related issue, the buyer does not have an import license and still I ship the goods and then the goods are dumped into sea or they have been auctioned, then also the ECG does not pay. So this means that whenever I am shipping goods to a country where there is a requirement of import license by the buyer, I must insist to get a copy of that import license before making shipment. Insolvency of agent or collecting bank, exchange loss, forex risk is not covered here. And general insurance policy, our marine insurance policy covers the general insurance policies, so that is also not covered here. Now, there could be exposure on single buyer. I am going to ship goods to one buyer. I got an order, single buyer in one country. I can take a new policy. Or I find a country riskier. I can take country specific policy for multiple buyers in that country. Single consignment, specific consignment, services policy, construction work policy, variety of policies are there for export. Now, the country risk. ECGC has categorized the countries into 7 risk parameters: A1, A2, B1, B2, C1, C2, and D. A1 is insignificant risk where the premium will be low if my buyers are situated in USA, Singapore, Spain, Australia, etc. In A2, the countries in low risk would be UAE, Thailand, Saudi Arabia, Philippines. Uruguay was somewhere down in B1. Now it has been brought up to B2, A2. In B1, moderately low, Panama, Taiwan, Namibia, Peru, and Bhutan. B2, moderate risk is Jordan, Barbados, Greece, Fiji, and Bolivia. Now, Fiji has been brought down from B1 to B2 in October 24. Bolivia, which was in C1, has been brought up to B2. Moderately high risk, Maldives, Russia, Iraq, Turkey, and Gabon. Gabon was in B2, it has been brought down to C1. And C2 countries are Burundi, Djibouti, Pakistan, Myanmar, and Ukraine. And very high risk is Afghanistan, North Korea, Yemen, Namibia, and Ethiopia. Ethiopia was in C1, it has been brought down because of the crisis there. Now, I can always take the decision on the country risk based on these parameters. This list is downloadable from ECGC website. This is updated every quarter. So unfortunately, I have not updated it for 1st of January, but it will definitely be there. And every quarter you can see what risks are there. There are public announcement about the country risk coming in between, coming up or going down. So whenever you are finalizing a deal with some new country, you can always go to ECG website and see how this can be done. So this is all on my take on the credit risk. So take insurance, then couple of other products are there, non-recourse products. So non-recourse product like negotiation under LC, on non-recourse basis where even the bank has funded your transaction, but they cannot take it back if it is a non-recourse negotiation. Factoring is another tool where if you do a non-recourse factoring, then even if it is once it is financed only up to the maybe 80% or 75% of the money you have received, your risk is controlled up to the margin which has been retained by the factor. So this is all on the credit risk. Now we move to foreign exchange risk. Foreign exchange risk is not only when I'm getting the money. Foreign exchange risk is starts from right of the time I quote to a buyer and till I pay and the amount is converted into my currency or I'm using that amount. Right from the time I am quoting till it is paid. The risk is because there is a movement in price of the foreign exchange. Foreign exchange is the most volatile commodity in the world. Every 3 to 4 seconds, the price would change. And for that, you need not go to rupee and dollar pricing, but you need to go and see the ticker which changes for euro, dollar, or maybe dollar, Japanese yen, or even the pound dollar in one case. So those currencies would move faster than any other commodity. So movement and volatility in prices will affect my business or my realization ultimately. It would also lead to cash flow gaps. Foreign exchange coming in or going out, cash flow gaps could be there, which could result in a risk for me. Cross currency risk when I'm not doing straight to dollar and rupee, because rupee is largely quoted in dollar. And if I want to go for euro pricing or Hong Kong dollar pricing or Singapore dollar pricing, then I have to go through, one is the dollar rupee, another is the euro dollar or dollar Singapore dollar, dollar Hong Kong dollar, etc. So for controlling this risk, I have to adopt certain tools, including the hedging tools. Let us see who is affected. All individuals are affected by FX flows. Whether it's a traveler, I want to go abroad maybe in the month of February, and I had planned this sometime in the month of October, when the dollar currency was available at 84.50. Now today when I go and ask the money changer, he says, sir, 86.50 maybe nahi. If I want to carry $1,000 with me, straight away 2,000 rupees, I am affected by that. Then the corporates were the exporters, importers, commodity and services, the investors and multinationals, lot of money coming into the country, lot of money going out of the country, multinationals who want to invest here, or maybe the FDI coming in, everybody is affected. Or maybe certain ODI proposals where I thought that I will invest in my new plant in some country, and where I wanted to send abroad $1 lakh. Now that dollar has become so costly that I have to spend 2 rupees more per dollar for that. Lenders and borrowers in one or the other country, if they have a currency exposure, arbitrators and speculators, this is the biggest maybe species, I should say, who would move the market, because in the overall trade during a day, if I say that there are $3 trillion worth of trades in the globe, then maybe 90% of it is only the speculators or arbitrators, only 5 to 10% is the genuine trade or the cash flows. Now, even besides that, even if I don't want to use anything, I'm not an exporter, I'm not an importer, I'm not a traveler, etc. Even then, a domestic manufacturer who is using imported raw material or who is not using imported raw material also will get affected by that, even a common person. Now, the factors, why does it change so fast, or why there is a volatility in the trade? The volatility in trade could be because of various reasons, which we can bifurcate into fundamental factors, technical factors, or speculative factors. The country related could be fixed in a fundamental factors bucket. The balance of payment, the economic growth rate, the fiscal policy, the monetary policy, the interest rate scenario, the arbitrage available between the currencies, etc. The political and the stability of the politics or the policies, that is a major factor. Now, country as India as a country, still we have scope to grow at a faster rate than other countries. But what has recently changed is something which is beyond our control. The changes which the globe sees in the US politics and policies, and leading to that, the policies and politics of some other pro-US countries. Because of that, this slide is there, not because of we are going to grow at more than 6.5% or 7% only. And maybe things would stabilize in a year or so. Then unrealistic value of currency due to government policies. Now government wants to control. Now here what has happened? There has been a slowdown, a gradual fall. If the government decides that we want to keep at 90 rupees, then they will stop at 90 only. So the pegging of the currency, that is not there, it's still with us. Freedom or restriction in movement of the capital, huge surpluses, sudden and large inflows and outflows. And speculative factors are relating to demand supply, expected price of the currency in future, and that view which is being taken on the currency for today, for tomorrow, for spot, or for a longer period. We have variety of exposures. The transaction exposure is what we call is costing rate versus realization rate. I have calculated a price today and quoted, say, $5 a piece to somebody taking 86.50 as a price. But when I realize the money, I get only 86 rupees. That is a transaction related exposure. The other is translation exposure, which as per C Institute AS 11 guidelines, every balance sheet date I have to revalue my assets and liabilities and all the exposures in foreign currency and book it as a profit or loss for a day. That is a translation related. Maybe it does not impact on a long term, but for that balance sheet date, now all those who have got an exposure or a maybe ECB, say millions of dollars of ECB, where the price last year was 84 rupees, and now they have to revalue, say, on 31st of December at 86 rupees. For this quarter balance sheet itself, it will make a dent. And the economic exposure relating to indirect effect on the change in rates, price of raw material, consumables, competition from importers, competition from other international suppliers, etc. These are all economic exposure. So all three will affect the bottom line. Bottom line of that particular day. The translation exposure is for that balance sheet date. The economic exposure for a tenure, because it will impact my business abroad, and the transaction will be a pakka impact on my balance sheet because I was to realize 8650, but I got only 86. So how do I stage it? The stages could be conception. When I quote or when I bid for a price, when I bid for a contract, that is the conception of that exposure. That I risk I'm taking already. Maybe today, if I want to bid for an export contract and if I take 86 rupees as a base price, I have decided that at 86 realization, I am going to earn 10% profit. But say that there are no major changes in the US government announcements and we bounce back and there are large inflows subsequent to our budget and maybe the March also, then whether it is possible that the rupee may come down to 85-50 back. Yes. Where is my risk? My risk I have started at 86. So conception. The next is birth or firm order. Now, by the time I get an order, it still remains to 86. Maybe 1 month. Normally, when we give a quote for an order or give a bid, it has to remain open for a certain number of days or maybe a month or so. So once the order or the quotation is accepted and I get a firm order, that is the day it is fixed that I this risk will be there. In conception, may or may not be there. But at birth, it is fixed that the risk will be there. I have fixed price at 86. Now, when I supply, I must get 86. The anniversary is AS11 translation related, and also the death or culmination. When I actually it is realized, it could be 86, it could be 8650, and it could be 8550. Now, why I need to understand risk management? One is the greed. Even if I have calculated 86 rupees, I want the best rates, 86 plus only. So optimization of profits is my goal. I should delink both these words. One is optimization of profits and another is greed. Don't enter into greed. You are optimizing the profits, you are getting better, something better than 86 or 8650. Take that. You are safe. If you go in for a greed, 90 ho jayega, 92 ho jayega, there are some pundits saying that 100 ho jayega, but nobody says kab hoga. When the payment comes on that day, whether it is going to be 90, if you are fortunate, yes. If you are unfortunate, it will be 85 on that. Then whether I can use any of the hedging tools, forwards, options, futures, etc. Yes. If I want to optimize, I should use those tools without going into that greed factor. Now, how I will make a policy will also impact because of generated out of my risk appetite. If I have 25% margin, profit margin in a trade, my risk appetite is more. I can play 5% here or there. But if I am working on a 5% margin, where is the risk appetite? My greed would take this trade into loss. So I can work on budgeted rates, the costing rates, the forward rates at birth. What were the rates when the order was received? I have quoted at 86, but 90 days somebody is going to give me 86.50. My forward rate at birth is 86.50, so that should be my target rate. And based on that, I have to prepare the strategies. Now, let us look at some of the tools. 1 second. foreign currency accounts. By opening or by routing my inflows into foreign currency accounts, I can manage risk in a shorter way. What are these? I got a money today. Yesterday the dollar was 86.50, sorry, 86.80, and today is 86.50. If my gut feeling says, and if the market says that in 2 days again it may go back to 86.80, I can hold those funds for 3 days, 5 days, 10 days in EFC account. Maybe I can book a forward contract if I don't want this money. If it is going to remain idle in current account, I can book a forward contract for end of January or end of February also, by getting that premium over 85.50 or 86.50 or so. Similar account for diamond merchants is diamond dollar accounts up to 5 permissible. Now EFC, I can maintain EFC as a piggyback account to my current account. And I can have in euro, I can have in dollar, I can have in as many currencies which the bank is offering. For SEZ units, there is a special foreign currency account. Now, the peculiarity of diamond dollar account or EFC account is that whatever a credit I receive in this month needs to be converted into rupee or used in the subsequent month end. So, January, whatever credits I received, the total credits received in January is $50,000. By the end of February, I should use this $50,000 or convert this $50,000. If not, then I will have to convert it on the last day of the February. Even if I want to book forward contract for this $50,000, I can book up to the end date of February, 28th of February, compulsory to be converted on that day at a given rate. But this compulsory conversion factor is not there for SEZ units. So there is no, it's a normal current account in foreign currency similar to our rupee current account. Now, about this, just 2 days back, RBI has announced a new facility where foreign currency accounts abroad have been permitted in general. Earlier, we had to go to RBI for approval. So, for similar facilities, similar to EFC account, a new facility has been announced where I can open an account with a bank abroad, park my export relation there, and from there itself, I can pay for my imports. Now, how this is going to come, because of those operational guidelines are still awaited, banks will have to work on that. I think FedI will also have to come forward and see how this is to be done. And the things related to that, like closure of my bills, handling of my bills, payment adjustment, credit related aspects, all those things will have to be seen. Other than this, there are risk limits which I can put on country, credit, and currency also. I find that certain currencies are too volatile. I will not draw invoices in those currencies. I will say I am satisfied by drawing invoices in dollar only. You take care of your currency. I will not go and draw invoices in certain third world countries, even though if the buyer says so. Okay. Then credit and country we have already seen. Then set off and net off. These are two facilities, one available to DTA units set off and another net off available to SEZ units. Now, where I have got exports and imports from same parties, maybe I am getting raw material from a party in Italy and I am making finished goods and then sending those finished goods to the same parties by doing certain manufacturing process or value addition. $1 lakh export, imports, $1,25,000 export. I need not remit $1 lakh and bring $1,25,000. I can only get $25,000 and set off this transaction one-to-one with my bank. So both import bill and export bill are closed in full. So receivables and payables set off. It could be other side also, exports of $1 lakh and imports of $1,25,000. But the condition is that the party should be same on the other side and the shipment should be for the same calendar year. Now, when I move to SEZ units net off, the same calendar year condition is not there. Because a lot of SEZ units are there which are maybe subsidiaries of foreign companies, wholly owned subsidiaries of foreign companies, which are there here in India only for the manufacturing process because of the cheap labor conditions here in India and maybe the technical know-how which is available here. Borrowing in currency of export import, PCFC buyer's credit. Now I have a dollar invoice. If I take rupee credit now, maybe 90 days processing cycle, another 90 days credit realization, bill realization, so 180 days. I will get dollars after 180 days. I am exposed to that risk for 180 days. Instead of that, I ask my bank to give me dollar finance only, whether I need dollars or not. I can encash it at today's rate. Aaj ka din acha hai, I can take it at today's rate. So my dollar is encashed today. Now the only worry is that the buyer should pay on 180 days. And on the import side, I can defer my payables by bringing in some financer in between. And the hedging tools. So we will see what hedging tools are available. Now here also, I can hedge on the basis of my actual exposure or anticipated exposure. Hedging is what? I will hedge a rate or I will fix a rate on the basis of the actual bill sent or an actual order received. But what if the order which I may receive in March, based on my past track record, anticipated exposures are also permitted under RBI guidelines. Hedging tools, there are three major tools available here: forward contract, options, and futures. We'll see all these three. I can book gross exposures, exports separately, imports separately, payable separately, receivable separately. Or I can do a net exposure closure also. $1 million exports, $750,000 imports, $250,000 only booked. That is net exposure. What is a forward contract? A binding agreement between two parties to purchase and sell a specific quantity of foreign currency at a specified price. The price is fixed, the future date is fixed or a range of date is fixed, and specific amount is fixed. I will get a rate today. When I say, go to a bank and say, sir, I am going to get $50,000 of export payment sometime in the month of April. The bank will give me a rate which will be applicable for the month of April for $50,000. There is a binding contract between the bank and the exporter. The risk of probable loss arising out of the adverse movement of price of currencies can be avoided. I am avoiding a greed or maybe price movement. If the bank is giving me 87 rupees today, I will take that 87 rupees for April and then sit tight. I don't want to see whether it goes to 89 or it's coming back to 86. It is an obligation of the buyer as well as seller. Given date or date range. In India, it could be a fixed date, it could be a date range, maybe full April, 16th March to 15th April, last week of April, 15th April to 30th April, 15th April to 15th May, like that. And these are OTC contracts, made to order, like stitched coat. It's not a ready-made shirt or ready-made trouser. So I can book a forward contract for $39,470.60 or euro. I can book for $1 lakh, I can book for £1 lakh, etc. Any amount, odd, even, anything. Now, against this, there is an option contract. Now, from the word itself, something new is there, that an option contract is a right to buy. When an exporter or importer goes, he gets a right to buy or sell a currency at a contracted underlying on a given date at a pre-agreed price. Now, largely these contracts are fixed date contracts. I get a right to sell dollars which I'll get in April at say certain price. Now, if the dollar goes to 90, I may not sell at that rate. So that is an option which I am getting. The buyer gets the right, but is not under the obligation to perform. I got a rate at 87. It is my right that I will sell the dollars to the bank at 87. If I deem it not fit, then I will not sell the dollars at 87 to the bank. I will allow that contract to lapse. If the market is 88, I will not sell at 87, of course. So I get a right. The seller is under obligation. While the buyer gets the right, the seller is under obligation. What? to accept the dollars at the given rate at the given rate. Now, when I am getting a right, should it be free? No, it is not free. So what is it? The right to buyer comes at a price which we call option. So maybe I'll have to pay a premium of 20-30 paisa to the bank to get this right. Maybe if the difference is more, I will go and sell the dollars in the market. If the difference is not more, then I may maybe go and sell the dollars to the bank at 87. The third one is a future contract. Now, future contract is similar to forward contract. Forward contract is an OTC contract made to order. A shirt made between 42 and 44, sleeve chota, collar bada, everything. But in a future contract, it is a standardized contract. And these are traded on exchanges, future exchanges. The buyer and seller are under obligation. Now, similar to forward contract, the buyer and seller are under the obligation, except for that standardization. Futures exchange is one of the party. Now, futures exchange are dealt by the exchanges, future contracts, whereas forwards are dealt by the banks or financial institutions. The contracts are standardized in case of lot size, the delivery dates and periods. The lot size could be $1,000 per lot, or $10,000 per lot, or $50,000 per lot. So whatever futures contracts are traded here in India, the lot size is $1,000. Now, if I have to book a forward contract for 39,450.70 cents, then either I have to take 39 lots or I have to take 40 lots. Now, I have a delivery date of April 17th. I am expecting payment on April 17th. To a bank, I can book a forward contract from 15th April to 30th April. But the future contract says, the exchange says, for delivery April, the expiry date is last Thursday of April. That is maybe that could be 27th or 28th of April. I have to mandatory, if I do a April contract, I have to bridge this gap in such manner that the dates, etc. are done. So that is why in a future contract or those contracts which are traded on exchange, the actual flow of currency is not there. Only the difference of price is there. So with these three tools also I can book. Now, let me tell you that when I book a forward contract, it's better to book a forward contract or go in for a future for a smaller lot size. But wherever I am bidding for a larger amount, even between the bid, the conception and birth, the contract or an order, I can go in for an option by putting maybe 10-20 paisa at risk. Maybe if I get an order, then what happens there? Now the rates are all quoted on spots. All the rates are normally quoted on spot basis, which is more volatile than forwards, and forwards are only based on the interest rate difference. So let me take an example. The forward is a value, the forward value of a currency is higher than the spot value where the interest rate is lower. So in case of dollar and rupee, the dollar interest rate is lower. So in forward, the dollar is at premium and the rupee is in discount. If the interest rate of rupee is 6.5% and the dollar interest rate currently is around 4.5%, say for a period of 6 months, then ideally the dollar is at 2% premium annualized basis. Now, this translates that if the dollar is 85.60 today, the 1 year forward ideally would be 87.31, 2% premium, not spread out equally for 12 months. It is not 1 rupee 71 paisa means does not mean that 15 paisa every month. No, it could be 15 or 20 paisa now and maybe in the later months 12-13 paisa also. So I can have various strategies for foreign exchange risk. I must have a larger corporate risk policy where credit risk and exchange risk are part of that. So in a corporate risk policy, I will also have a normal insurance policy. I will have a fire policy. I will have a renewal policy. All those things will be there, including the system risk. Then I'm based on the size of my operations, I will have to decide whether I'm using the Forex risk management as a risk management tool or I want to add and get more money out of it. So that goes into another part by making it a profit center. Now, somebody making it a profit center must have a proper manpower, proper tools dedicated to Forex risk management. So those exporters and importers or the the corporates who have got an export-import volume of maybe 500 crores and above, or maybe 300 crores and above, must put somebody on the desk to manage those risks. You can also outsource this. Maybe there are consultants in the market where for those who are having turnover of 20 crores or 40 crores or 50 crores, they can outsource it. I must also have by limits, control limits in place. So stop loss limits and benchmark levels where I will book, where I will cut my loss. And every regular interval, 15 days, 1 month, I must evaluate my losses and profits and see that whether I am going in the right direction or not. And this must be perused to the top management also. There could be maturity gaps in your inflows and outflows and the forwards book. So that also need to be managed. That is also an exposure by currency, interest rate, etc. Why I should have a risk policy? It gives me a clarity of actions and a path on which I would go. Stability in profit or loss. Stable profits. If I decide that I will book a forward contract for all contracts, immediately I get an additional 2% for all contracts. I'm not going into date. Rupia kahan jayega, kahan nahi jayega. I don't want to go into that. And secure margins. And I can have a peace of mind by concentrating on my business rather than indulging in all this risk of whether rupee will go to 90 or whether rupee will go to 80 or whether rupee will go to 100. Then the necessity of maybe understanding the risk and mark to market on a monthly, weekly basis based on the size of operations, manpower available, understanding available, etc. So post the bank's presentation, we will have the question answers. These are my credentials. People who are interested can take it down. Maybe get in touch with me on WhatsApp or email and take it from there. We also support exporters and importers in framing their policies or maybe guiding them on various aspects of trade, including regulation of bills, FDI, ODI related articles. So thank you once again. Learning never exhausts the mind. Keep learning, keep exporting and building your profits. Thank you very much. Thank you, IFAI, and thank you, ICICI.
Thank you very much, Gaurang. I think you have covered very nicely regarding the risk factor. Either you can say the currency risk, or we are talking about a hedging strategy. What hedging strategy we should adopt to manage the currency risk and benefit of the risk policy. I think this is the most important aspect which you have already touched. So thankful to you. If any questions will be there, we will come back to you. Now I'm requesting Shri Joshi sir, who is SME Trade Finance ICICI Bank. This is our 9th program with ICICI Bank. I think your feedback is excellent. And ICICI Bank is also helping the entrepreneurs, all the exporters, importers, and you can use the services of ICICI Bank. Now I request Mr. Joshi to give his views in respect of the risk or any facility being provided by the ICICI Bank. Mr. Joshi, please.
Thank you, Gupta sir. Thank you for this opportunity for presenting a session at your Zoom meeting. Good evening, friends. I am Bhavin Joshi. I am from ICICI, and we have been actively participating in MSME development projects, and I believe the organization is helping MSME to have their projects successfully implemented and go to the next level. We at ICICI have been helping the customers to have all their international trade transactions executed seamlessly with the help of our various products. And primarily, the flagship product happens to be the digitization, the trade online product, which we have been marketing and we have been informing MSME to avail our trade services. Our trade online product has been helpful for customers to not only have the transaction process, but also provides the real-time update to the customers with the transaction which is taking place at our counters. We also share the SWIFT message copies immediately after the transaction takes place, and the customer is able to witness the advice copies within the same platform. We also provide customer support both during the execution of the transaction as well as post transaction. Next slide, please. So on our digital platform, the Trade Online product, we are able to reduce the turnaround time with respect to settlement of inward remittances, wherein we have a capacity of settling inward remittances within an hour's time. We have a capacity of issuing a BG within 3 hours time frame, and any outward remittance with all the documents in place as per the requirement, regulatory requirement, we are able to process within 5 hours. We have provided swift message copies to the customers within 5 hours time frame and issued BGs within India within 3 hours. We have been able to settle inward remittances for all the exporters, whether it's an EFC account or a current account, within an hour's time. So this happens to be our USP for any trade transaction handling proposition. We have also come up with a new product called Mobile InstaBiz app, through which our customers can get their EPCs, packing credits, disbursed through a InstaBiz package of ours, wherein any proprietary firm or a partnership firm wherein the authority is able to operate the InstaBiz can order for an EPC on the move. Our bankers have delivered this disbursement of export packing credit through a request which is being received through InstaBiz, and subsequently we obtain the underlying document for ratifying the same. We also have the capacity of issuing paperless BGs with the digitally signed BG and stamping thereof. We have an arrangement with around 28 odd government agencies or PSU companies through whom we have been able to issue the paperless BGs. We also have a flagship program called Forex Online, FX Online, the term used, wherein our customers are able to book Forex rates through this platform. The Treasury also provides reports through this platform, which also gives an insight of the global market. We also have a facility of having capital account transactions vetted. We have a team of experts who can guide the MSME for having their foreign currency FDIs or ODI transactions handled. We have our online portal for pre-verification of FDI filings. We help the customers to seamlessly file all their regulatory filings with RBI for fulfilling their compliances with the regulator. And there is a current account variant what we have offered to all our MSME customers, which is called as One Globe Trade Account, which helps the customers to have all the services availed at flat charges, at flat rates. So irrespective of the dollar volume which they or dollar throughput which they execute through our bank, the rates applied would be flat towards the bill commission, towards the outward remittance commission, whatsoever. So these happen to be our flagship products which are largely appreciated by MSME segment. Next slide, please. Our Trade Online program has been helpful for customers to have their export bill regularization done, to have their export credits disbursed, to handle their collection bills, and it also helps them to settle inward remittances and issue bank guarantees. Here, the customer is able to schedule his requests with respect to EPC disbursements also. It can also schedule its bank guarantee issuance requirement, and bank would be able to issue the BG based on his request. We have the capacity of no setup cost for any Trade Online customers. There will be paperless transaction acceptable. There's a quick turnaround time and the services available round the clock. We as a bank has been also able to provide audit trail or all the references of the or of the trade transactions which have taken place with our bank. For example, if there is any kind of bill outstanding for which the IRM has not been stated, or the customer has received the IRM with some other bank but is still pending at EDPMS, the bank can provide this information through Trade Online, and the customer can have it regularized by settling the IRM against the bill which has been lodged by the bank. Similarly, we have the capacity of regularizing import bill ORMs against the bill of entry. We get this bill of entries knocked off against the ORM based on the available information of the dashboard on our Trade Online platform. We have the facility of scheduling issuance of letter of credit. The customer has the facility of choosing or saving the templates of various suppliers to whom the LCs are issued at regular intervals. It helps to quickly get the LCs issued with the standard terms and conditions, and it helps the customers to have the LCs issued on timely basis and thereby import of material. We also execute service payments through this platform, which helps all the service providers to avail our services with respect to trade transactions. Next slide, please. The unique feature of Trade Online happens to be it provides the facility of templates to be saved, which helps for regular outward remittances or having LCs issued. To that extent, it has a facility of scheduling a payment as well for any kind of due date specific outward remittances to be made, LC bills to be paid. We can have a scheduler set in our system. We have a capacity of having bills regularized through our platform, where on our dashboard we provide all the outstanding bills which are to be closed in terms of export bills against which the IRMs need to be settled, and against ORM all the bill of entries which needs to be closed. There is a single view dashboard which is provided on our Trade Online platform, which enables all the customers to fulfill their regulatory requirements. There are timely custom alerts which are being sent across to customers for various outstandings, various regulatory pendencies, or to that extent, any transactions being executed are also informed through this platform. There is an instant EEFC conversion facility on our Trade Online platform. We have a FX Online deal booking facility, as I informed earlier. And there's a virtual guidance as well provided by our team to all the customers while having the transactions executed. Next slide, please. As we said, we have the capacity of having foreign currency accounts opened in terms of EFC, special foreign currency account, and diamond dollar account. Our EFC account happens to be opened for around 26 odd currencies. We have a capacity of quick conversion of any EFC balance with our bank. Our bank has also offered special foreign currency account for all SEZ units who are able to maintain their foreign currency in their SFC account. For all our diamond tiers, we have a account called diamond dollar account, wherein they have all their local diamond trade transactions carried out through diamond dollar account in foreign currency in US dollars. Yeah, next slide, please. With the new invention of our bank with respect to InstaBiz platform of our mobile banking product, the InstaBiz package of InstaBiz app has been helpful to the customers for executing all their banking transactions through InstaBiz. There has been a requirement of EPC there has been a requirement of disbursing EPC through mobile banking, and our bank has been able to fulfill this requirement through proprietors and partnership firms where the single authority would have the capacity of requesting the EPC requirement for the company. They can also apply EPCs digitally, and they can avail this disbursements through InstaBiz or through Trade Online platform. We have the facility of providing run account facility, and if at all it's an order based disbursement taking place, within 30 days the customers are requested to submit the underlying documents for fulfilling the regulatory part of this EPC disbursement. Next slide, please. Next slide, please. Yeah. So along with Trade Online, we also have one information sharing platform called as Trade Emerge, where we can help any new businessman or new entrepreneur who intends to start his export-import business. What are the guidelines for a startup? What are the guidelines as to how the business could be started? What are the regulatory requirements? Can be guided through this platform. We have also provided this information through the various platforms connected have a buyers and sellers list of various industries wherein the customer can identify its suitable buyers and sellers. He can also have a verification done of a genuine buyers and sellers with whom he can deal with. This platform also helps them for arranging logistics and provides the information about the logistic partners to carry out international trade. The platform also helps to identify the insuring agents which can provide the marine insurance, the group health insurance, so on and so forth. The insurance companies listed would be the list companies which are day in day out been able to facilitate international trade, and various knowledge based hubs which help the customers to understand the various direct taxation, indirect taxation, regulations, DGFT, customs laws, etc. through this platform. So that's it from my side. Thanks, Ahai, for giving me this opportunity for sharing the trade products and the flagship product of our company. Thank you.
Thank you, Bhavan sir, Bhavan Joshi sir.
Thank you.
I think
Yeah.
you are all very thankful. What type of facility are being offered by the ICICI Bank? You're talking about the digitalization solutions. I think this is the most important aspect of the days. Innovative product, you're talking about the instant disbursement EPC. I think this is also very useful. Above all, you told the verification of the buyer and seller. I think it is very useful for the exporter or any party who want to enter into a new type of business to get a list from you who is can be buyer and who can be seller. I think it is very useful. And you're talking about the bank guarantee being issued within 3 hours. I think this is also very important aspect for our entrepreneur who are listening to that. That means they must avail the services of the ICICI Bank. So I think we are trying to cover today what are the risk factor exporter is having. And whether you're talking of the exchange risk or you're talking about the buyer risk, insurance are being provided, and what are the mitigations that we also try to cover how it can be mitigated. And how the ICICI Bank is giving the facilities regarding the digitalizations and innovation aspects. I think this is the most important aspect. At our end, we are Association for Financial Advisor of India. We are more than 400 members with us. Every week we try to do some webinar, virtual webinar. And also we are trying as the association banner, we are doing the conferences. Either we have already done co-lending and we are also doing something for the green energy. That association is playing very important role for the help of the financial advisors. So we have a great team with us, like Mr. Rajan, who is the director of the company, Mr. Gupta, who is the director of the association, finally Financial Advisor of India, and Mr. Ayush, and Mr. Lokesh, Mr. Devashish, and Ankit Singh, I think, and Mr. Vishesh Chaudhary, who is the office secretary, who are always helping us to design such program. And we are getting a good feedback. Till today, nobody asked any question. So I feel that Gaurang sir had rightly explained all such things, so there is no question from your side. If still you want any question which you have in mind, you can write to us or you write to Gaurang, or write to ICICI Bank also. So that proper reply can be there, which can be useful for you. I think this is my request to you, all of you. And beside that, the Resurgent India, which is a investment banker and merchant banker, we also provide the draft project report. If any assistance is required from the Resurgent India also, because we are also conducting a technical economical viability study. That means under DPR, any assistance of the financials that we are ready to provide you. So I'm thankful to my participant, Mr. Gaurang sir and Mr. Joshi. In the end, I can again request Gaurang sir if you can give some last word, any suggestion from your side to our participants. Mr. Gaurang sir. Say something?
Sir, I think nicely narrated the seminar proceedings. The last word, what I would say is that don't take unnecessary risk, because every month we get people from various seminars connecting with us subsequently, which say, sir, because of the because we are new in the market, we got duped on the credit side, etc. Try to cover yourself with maybe credit insurance, and also when the market is maybe favorable to you, do forward bookings or take the advice from the bank. Don't take unnecessary risk on your foreign exchange exposure also, because that will take your sleep. Don't do any of the products or use any of the products on the foreign exchange side which you don't understand. So that is why my last word on the last slide was that keep learning, and then you can maybe curate your business in a good way, rather than taking risk which you don't know also. So know the risk and then do the business. That's the mantra I should.
Very
Thank you
important.
very much, sir.
You must know the risk, then you do something for the mitigation. And Mr. Joshi is there. Joshi ji, you want to say something? Mr. Joshi? Okay, Mr.
No,
Joshi.
sir,
you want to
nothing
say
else. That's it. That's it. Use
Thank you.
avail ICICI Bank services. That's the limited one.
Very nice, very nice. Thank you very much, Mr.
Thank
Joshi
you.
and Gaurang sir, and all my participants for that. I'm really obliged. Thank you for that.
Thank you very much, sir.
Thank you.
sir. Thank you.
Thank you.
Thank you, Gupta sir, for leading
Thank
the
you, sir.
ninth
Thank you.
Thank you.
ICICI as well as AFI webinar in a row. And
Yes,
we
sir.
have many more webinars under your guidance and leadership. And with the support of ICICI Bank, we'll do more webinars. Thanks a lot, sir.
Thank you very much.
Thank you.
Thank you,
Thank
sir.
you very much. Thank you all.
Well,
Thank all.
no one is